Hey everybody, Peter LeSar here, and welcome to episode one of Restaurant Strong News and Analysis. And today is an important day because I feel like there's been a gap that's been missing in our industry, and that is really great analysis to go along with the information of sort of what's happening day to day. And so let me explain. For many years, I have been the CFO of a publicly traded hospitality company. I was the president of a multinational hospitality company in Asia, over $100 million in revenue in the former, and over $50 million revenue in the past, thousands of employees. And even with all those resources, having access to really great analysis of what was going on and sort of what that meant for my business today, tomorrow, and the day after was always missing, right? In other words, there are great news aggregators about restaurants or about the world in general, and you can surmise how the news impacts on restaurants, but not anybody that was saying this is happening, and here's how you can think about it in the context of your business, right? There are many great interviews out there with restaurant leaders, and yet most of those interviews are really about them and their businesses, and we have trouble extracting sort of what is going on a wider level from those interviews and what that means for your own insights and your own actions to come, right? And so I felt like it was time to start to fill that gap, which we're going to start to do today in a very humble way. And all I really want to do is week by week give you great content that gives you great insights that helps you to shape the restaurant world today and tomorrow in your mind, so that you can live the best sort of business life and restaurant life that you possibly can. So, having said all that, today and in all episodes to come, we're going to be moving back and forth between five different categories of information and analysis. The first is what is the macro world telling us about the economy, about finance, about food supplies, about inflation, and so forth, and how's that impacting us on today that we might not be seeing exactly, and how it will change and shift our businesses tomorrow, right? The second is what are our leaders doing, and what from their activities can we learn about what we might consider doing ourselves that might not be obvious to us. Three is what is happening with technology below the surface, and that should be bubbling up in the months and years to come, that if we were aware of it and followed it deeply, we could develop ahead of the curve rather than behind it, as so many do. Fourth, what are emerging leaders up to that we don't even have any clue who they are, and yet they are starting to show clear trends of what is changing, what will change in the years to come, that it'd be better if we knew now rather than then, before we were caught off guard, right? And finally, what does all the news and all the analysis of the news tell us about first principles of outperformance in this industry? And so let me explain. Many of you will know that I'm the author of the book Restaurant Strong, and Restaurant Strong is a 10-year research project into what are the first principles of outperformance in our business. And the truth is that the news gives evidence every day to what practices our leaders have used to separate themselves from the pack day in and day out, really on a universal basis, whether they're fine dining or fast food or everything in between, that many of us continue to miss. And so I want to use the current events to continue to highlight the practices that really make a difference, okay, on an ongoing basis, so that you can, over time, decide what makes sense for you, okay? Now, today we are going to deal with one issue and one issue only, and that is there a recession incoming? And we're going to answer three questions. The first question is there a recession coming, and when? The second is, who is likely to be most negatively impacted and who is likely to be least impacted? And the third is, how do you mitigate risk in a time like a recession, and what do you do to sort of leverage the moment and come out ahead when we're heading into a recovery. Okay. Now, if you like this video, please go ahead and subscribe. Please give the video a like. You'll get notified every week as these episodes are coming out. And I think that over time, what you're going to find is I'm trying to provide real value and real insight to your business life. Okay, so I'm going to move into a shared screen here. If you give me 1 second, and let me just go back here. So while I'm talking, if you have any questions or any comments, please go ahead and feel free to leave those below, and I will do my best to respond to people in a timely basis. So our first article that we're going to review, and we're going to review a series of articles and data points, and we're going to come back at the end and answer those questions, starts with this headline: very, very high risk of recession, warns Goldman Sachs CEO. And he goes on to say a couple of important points that we're going to briefly discuss. He says, first of all, that if I were a big company, I would add also to that a small or mid-sized company, I would be prepared for it. If I was a consumer, I'd be prepared for it. But it's not baked in the cake. In other words, even he, with all the knowledge and information he has at his fingertips, he's not certain there's going to be a recession. And that's just the truth. Nobody knows. Okay. What I can tell you is in the last 14 tightening cycles where the Fed has raised interest rates to reduce consumer demand when there was too much of a boom going on and inflation was starting to be threatened, in 11 of those cases, we had a recession. So the probabilities of a recession are high just based on history. Okay. Now, Blankfein goes on to say that there's a narrow path for the Fed to use its very powerful tools to avoid recession. And what we need to understand is that the Fed really can only do a couple of things. They can increase interest rates, right, to lower inflation, because as we all know, we're in this high inflationary environment, and that's their number one mandate right now. Or they can restrict the money supply. And in this case, they're going to do both of those because we haven't had inflation this high in 40 years. And so it's actually a very dire situation. And those are not precision tools. Those are not lasers, right? They are big, massive, imprecise hammers that are just going to bludgeon away at the economy until demand drops enough that it is equal to or lower than supply. And when that happens, when consumer and corporate spending start to drop, the pressure on suppliers drops, and they start to get worried and they lower prices. Okay, that's all they're trying to do. And because it's a bludgeon process, we don't know exactly what the outcome is going to be. Okay, now Article 2 says that we see a big recession in the making. Top CEOs are fearing the worst in Europe. And really, the top CEOs in Europe feel like they're on a brink of a recession or they're already in a recession. And what I'm trying to communicate is that recessions generally start in one area of the world, either the United States or Europe or China, Asia, and they domino effect steadily into other parts of the world. And right now, the United States is doing better than everybody else, but it also means that we're likely the last domino to fall. So this article says the Eurozone faces concurrent economic shocks from the war in Ukraine, a surge in food and energy prices exacerbated by that conflict, along with a supply shock from China's zero COVID policy. And this has prompted concerns about stagflation, an environment of low economic growth and high inflation, and eventual recession. So they have very high inflation, just like we do. Growth is slowing very quickly. Inflation continues to be exacerbated because oil and gas fuel the movement of goods around the world, and they're additive to the cost of goods that you buy. Russia and Ukraine produce a very large amount of wheat for export around the world. That wheat is now not reaching markets, and so wheat supplies, which are really a staple for the world, are going way up. And all that as growth is slowing. And that combination of high inflation and low growth is stagflation. And when we enter into stagflation phases, which happen only once every few decades, they inevitably tip into a recession. Okay. So we just have to be prepared that this is going to happen. We don't know when. Okay. And one thing that one of the CEOs of Europe's largest company states in here is that there's still an overhang balance of demand from COVID. Okay. As you know, when restaurants started to reopen and people started to take their masks off and come outside, there was a resurgence in demand for dine-in, right? And that has happened in many sectors across the economy. And so there's still tail ends of that demand in certain sectors that is keeping Europe and the US at higher rates of growth, right? But eventually that tapers off, right? And as that tapers off, that means demand reduces and we start to tip the other way. And that's exactly what Europe is worried about, okay? And finally, in relation to global recession risk, China recession risk sparks unease in economic circles with warnings of quarterly slowdowns. Now, this article is from a year ago, okay? So there are articles like this today in China, in relation to China. The China risk has been going on for a year plus, and when a country is in an unstable economic situation for a long period of time, they are very fragile, very vulnerable. And so if and as demand decreases in Europe and then on a domino effect in the United States, China could see a crash, and that could have then a knock-on effect back to the rest of us. Okay, and so if a recession comes, you need to wait out to see what all the knock-on effects are, because we're not going to know at the beginning what exactly the end result is going to be. Okay, now I want to take you to a slightly different opinion to help provide some context. U.S. economy shrinks, threats loom, but growth likely to last. And ABC News here is essentially saying that while the economy did shrink in Q1 of this year, as many of us know, GDP shrank, and faces threats from high inflation, rising interest rates, the strength of the job market and of consumer spending should promote growth throughout 2022. So they're basically saying that as long as there's job growth and as long as consumer spending is high, we're good to go, right? So I want to cover those two items in depth because there are lots of opinions out there and there's a little more context. This is what's called the US dollar currency index. And you'll see on the right that it says that today we're at about 104.225. Now, this is the value of the US dollar, the price of the US dollar against a basket of currencies, the euro, the Japanese yen, and a series of other currencies. And this is a 5-year chart. So what you're seeing here is that we are the highest point in the price of the US dollar versus this basket of currencies in more than 5 years, okay? And a highly valued US dollar means that imports are relatively less expensive. And so it's easier right now for us to buy TVs and for us to buy appliances and other goods that are imported, right? But you might not realize that the higher that record pricing of the US dollar extends, okay, the more likelihood is that it will start to revert back to mean, okay? And a lot of currency analysts are forecasting that basically it should turn between 104 and 112, okay? So we're in this range. And as soon as that happens, well, guess what? Then imported goods start to get more expensive. And when that happens, consumers in the United States have less disposable income for spending on domestic goods and services because they're still going to buy imported goods and services, right? We're a country that imports like crazy. And so typically when the US dollar reverses course, there's less disposable income for restaurants and other types of US-based spending. Okay, so we're going to be watching what happens with this chart in the coming months, but it should be very indicative of how you're starting to feel demand shift, okay, in your restaurant. Now, there's one other chart here that I want to cover, and that is this is the United States consumer spending chart, and extends from before 2000 all the way to today. And the good news is that it's growing constantly over time with just some dips, right? But in a historical context, even those dips don't look so scary, okay? And so if you are a restaurant that manages to survive the dips in consumer spending, i.e. recessions, right? And you become more competitive every year to earn a larger percentage of your local market, then you tend to do really well over time, right? And the key is doing both of those things. And so I want to help you to understand this in a historical context. The first red arrow to the left is the drop in consumer spending in the early 2000s recession after the dot-com burst, right? And it looks like a blip historically, but at the time, trust me, people felt it. Revenue flattened, revenue retracted for many businesses, and it was a scary moment. The next red arrow is 2008 to 2011, essentially, and you'll see it's a much deeper dip, right? And if you were around then, you're going to know that restaurants really suffered quite a bit in those years. Okay, and then the last arrow down is the COVID crash, right? Which had a very V-like shape and recovered very quickly, whereas the recovery from 2008 was much more extended. And so we don't know what sort of dip in consumer spending is coming. We only know that it will come this year or next year, right? And that's just the general belief in the marketplace that you cannot fight the Fed, and the Fed is intent on destroying demand from consumers and corporations, because it's only in demand destruction that prices come down, because demand and supply are rebalanced. Okay, you need to prepare yourself for any sort of possibility, a prolonged one, right? A short one, and that means you need to be thinking long term, and we'll cover that in just a moment. So how does all this impact on consumer spending in restaurants? Well, this is a table from the 2011 recession in the middle column, and the 2013 recovery, okay, from that recession. And it's always really helpful to look at historical context to try to extrapolate what would happen when similar circumstances occurred. And so if you look at the middle column, you'll see a first arrow that points up. Well, what this says is that spending in supermarkets related to all spending went up during the 2011 recession. But the arrow below that says that spending in restaurants went down in relation to all other spending because of the recession. Now, we generally know that's what happens, right? But what happens within the sector, okay, when you look at full service restaurants versus limited service restaurants? And they both tend to fall a little bit. Okay, there might be some that actually grow some, but they both tend to fall a little bit during a recession. Some more than others, meaning the full service restaurants tend to fall in revenue more than the limited service restaurants. I don't think any of that is news for you, but if you look to the recovery column to the right, and you'll see that bottom down arrow, in the recovery period, when the economy was back to growth, there was a new ratio in place between spending in limited service versus full service restaurants, in which there was continuing greater expenditure in limited service restaurants and less in full service restaurants for quite some time. Okay. In other words, people's habits continue for a while. They continue to be conservative. They got used to some places, and that can go on for years post a recession. Got it? And in fact, if you think about it, it's only when recovery turned to boom, really 2016 to 2019, when the rest of the industry started to see interesting levels of growth. Okay. And so we don't know how long it would be before the quick service restaurants recover, and we don't know how much longer it would be if a recession comes for everybody else to recover. And so your timelines really are dependent on where you are in the industry. Okay. Last page we're going to look at, and that is Google Trends for the term "sell my restaurant." How many people search on a daily basis for Sell My Restaurant, right? And if you look at May 2020, what you will see is the minimum number of people searching for Sell My Restaurant since May 2020 has been on an uptrend ever since. Okay. In other words, more and more minimum number of searches per day are going up. Now, the upper end has been a little bit all over the place, but the baseline has been lifting on a very steady basis. Okay. And since January 2022, it has actually been on a faster pace. Okay. And so as we have added labor inflation and food inflation, right, and labor issues, more and more restaurateurs are trying to get out of the business. And as the circumstances turn into a possible recession, I expect that slope to stay high or even go higher. We're going to be watching that in the coming months. And so your job is to ride this thing out, okay, if you want to be in this business, and understand that there are going to be lots of competitors that are going to be closing, and you are going to have a better supply-demand equation at some point down the line. It might be a year, it might be a couple of years, okay? But it will turn in your favor, okay? Now, let me just stop sharing for a moment, and we're going to answer my questions at the very beginning. So, is there a recession coming, and when? And I would say the general consensus is increasingly yes, that there's a recession coming. Nobody knows when. Some believe we're already in a recession. That is contrary to what I hear on the streets from many parts of the country, but not contrary to what I hear from other parts of the country. And so I would say it's very mixed right now and hard to read the national picture, okay? But generally, there's an expectation there'll be more volatility in spending and inflation, okay, between now and the end of the year. And the farther along that calendar we progress between now and the first half of next year, the greater the likelihood of a recession, unless somehow the Fed gets inflation under control quickly, which nobody really believes is possible. Okay? Now, the next question is, who will be less impacted and who will be more impacted? I think you now see this. The quick service segments will be better positioned over time. Everybody else will be less competitive for quite some time, likely. And this will be exacerbated if you operate in a market where there are many rental homes versus homeowners, because renters feel a greater impact from inflation, so their spending is even tighter. This will help be more negatively impacted if there's net outflow of migration in your area versus net inflow, right? So you need to measure all those things and figure this out for yourself. Well, one thing I would be doing if I were you is doing a sensitivity analysis of what would happen if my revenue were to flatten entirely or fall by 5% or fall by 10% and my costs went up another 7 or 8% in the next year, okay? What does your business look like then, and what can you plan for in advance, right? And so we still might be on the tail end of growth. For some of us, that's certainly the case. And I would even be thinking, okay, there's more employees coming into the market. It's getting easier to hire people all of a sudden. But I might have to turn quickly in the other direction if things start to change in my market, okay? And so I would hold on to all of your ideas very loosely if I were you, okay? And really how to mitigate your risk and how to prepare for more upside with the recovery. Save on the cash. Cash is king in these periods, okay? As much as you possibly can, and work on how to grow, okay? What parts of your business model are really working well that you can lean into, which are not working well that you can walk away from, and how do you optimize your business model? How do you get a better return on your marketing? How do you really have a business that's prepared for upside growth? When things are falling, even really great businesses can flatten or falter a little bit. But if you get stronger in a recession, your strength coming out of that recession will be even stronger than those that did not do the right work. If you have any questions or comments, please drop them below. Do give a like and a subscribe if you found this video of any value. Otherwise, we will see you next Monday.